Welcome to the Stock Play of the Day Overtime Edition. This week on Monday's Stock Play of the Day, we talked about the XLF. That is the ETF that tracks the financial sector. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest. Now, this week on the Stock Play of the Day, we talked about the XLF and the fact that many banks were going to be announcing earnings this week, a lot of the financial stocks just in general. So we did a little bit of a short-term momentum play. It was a long call spread in the XLF. So we looked at buying a little bit in the money option contract and selling a little bit of an out of the money option contract. Now, before we jump into the actual strategy, the first thing we see here is a chart of the XLF. When we looked at this at the XLF on Monday, the underlying stock was trading right around 23.65. Now, we always do the stock play of the day when the market's open, so it is a live quote that we are seeing. But as usual, we're just trying to learn here on the stock play of the day. We're not trying to make a recommendation. But what I've highlighted on our chart here is where the stock was at. So this is Monday, the 13th, and we see that this is the noon hour, and we have a 5-day, 15-minute chart. If you go all the way across, this is kind of what happened in, it's exactly what happened in the XLF in that we had a little bit of a run up right after the call. And then after our video was done, on the very next day, we actually had a little bit of a spike down, back to level, and then a big spike back up again. Now we see the XLF trading right around 24, and overall on the trade, this isn't necessarily a bad thing what happened. It wasn't extremely volatile. We're talking the lows were down to around 23, which was our low strike that we actually ended up buying. And the highs were up around almost 24 and a half, it looks like, over that 5-day period of time. So right now the trade is positive in that it's selling for more than we actually paid for it, but it's not a lot more because the underlying stock hasn't really jumped that much. From 23.65, it's now trading right around 24. And once again, we're live on the stock play of the day overtime. So this is a real-time quote and real-time situation. So let's run over to our option chains and let's do our quick review, which we do every Friday at noon Eastern time. Here's where the XLF is trading right now. It's trading at 24.03. We did have a few banks that announced earnings, and they were fairly uneventful in that they didn't really affect the stock prices too much. A couple of the big ones, and I'll just highlight a few of them. We had JP Morgan and Citibank. They announced on Tuesday. They are a little bit more diversified banks, and they actually beat on the revenue and on earnings. And then Wells Fargo did not quite do as good. Now, as of today, I went and looked at all the stocks. Actually, Wells Fargo, who disappointed a little bit on earnings, is actually doing a little better than JP Morgan and Citigroup overall. But the stocks are just up a little bit since they've announced earnings, and there's a few other banks that have announced earnings this week too. So what do we see in the XLF? Well, the XLF just creeped northward a little bit. Now today we're down about 11 cents on it. We're at 24.04. But more importantly, we are up from Monday where the stock was trading right around 23.65. So the trade that we looked at doing, we wanted to give it some time to play out, even though it was a momentum play kind of going into earnings, and we were speculating with a long call spread. So if we go over to the call side of the XLF Ally Invest option chains, we see the stock at 24.05, which I'm highlighting right now. We bought the 23 strike July 31st expiration and sold the 25 strike July 31st expiration. There's still 14 days remaining in this trade, so there were 19 days when we first looked at it on Monday. And if we scroll down, here's the actual midpoint quote. So right now on the midpoint, we're at $1.05. Now we paid 85 cents. So for every 1-by-1 spread that we did in our paper trade on Monday, that was $85, and that was our max risk. We could now sell it for 105 in theory, right? Because it's just a paper trade. If we sold it at the midpoint and got a midpoint fill, we got a really tight market in the XLF. On this spread, it's 103 by 106. So that's a very tight market overall when you consider you're trading 2 option contracts. And so that would be $105, paid 85 for it to start, 105 for every 1-by-1 spread. That's what we'd look to bring in. Now, don't forget to put commissions in here, commissions to get in and out of the trade. You'd have to think about that every time you're trading option contracts. Now, if I put this paper trade over in the right rail, we'd go probably try to fill it somewhere at the midpoint, 105. And what it would be here is that this would be a sell to everywhere that we had a buy to open, that leg we're going to sell. So on that buy to open, we're going to sell to close. And on the sell to open, we are going to buy to close. We'd be doing this at a net debit of one, or a net credit of 105 to the account. So this would have to be a credit. And that means that if we just closed out this trade right now, we would be up about 20 cents on the trade. Now, when we talked about it, that's a little bit early. The market did come down. I don't think it really went down enough for us to get out. And it did go up a little bit higher. So you might have been able to make more than the 20 cents that it's showing right now at some point in time. But we went out a little further in time. We wanted the earnings quarter to basically work its way through, and we were looking, we could make as much as $2 on the upside. That would be the maximum that the spread could trade for. Now that $2 minus that 85 cents would be $1.15. That's our maximum, so we're quite a ways away from that. But one thing that I just wanted to highlight here, and I have the original trade over here on my other screen. When we first put on this trade, the option contract that we were selling was trading for around almost 40 cents on the midpoint, and now it's trading for 23 cents. So I'm going to give you an alternative. You've made some money actually on the long call and on the short call. We're right in the middle of that spread. We still have, as I scroll up here, 14 days remaining. One option, one alternative here is actually close out to 25 call. If you wanted to just remain long that underlying call, some of the implied volatilities came out because we've had some earnings announcements overall in the XLF and some of the stocks that are contained in the XLF. So overall, you could think about just closing the 25 strike call option and remaining long the 23 strike option. But if you do that, you're going to be, you're going to add some risk to the position, because now you're going to be just net long that option contract as expiration approaches. But that's a viable strategy in this situation. You've made some money because of time decay on this option contract, and you also made some money because of a fluctuation in implied volatilities. When we first sold this option contract, I'm highlighting the volatility over here. That implied volatility level was up around 40%. Now, the overall market today is pretty much flat, but the VIX, the volatility index that tracks the S&P 500 index, has came down quite a bit. It's down a couple of points today, trading down around 26%. So overall, the volatility of the marketplace has came down. It's definitely came down in the XLF. It's part of the reason why we did a long call spread, is because volatilities have been high, and they've been high in a lot of underlying stocks ever since we've had the pandemic that has hit us, and we hit the March lows because of that pandemic. We've seen high implied volatilities across the entire marketplace. So that's going to be it for this stock play of the day overtime edition. In summary, you could close out the position, take that 20% gain. I think I'd rather stick around, see what happens going through the rest of the earnings seasons in the financials, or we could just close out that short option contract and remain long the 23 strike call with the July 31st expiration. Okay, thanks for coming. Don't forget to click subscribe and ring the bell, and we'll be back this Monday with another edition of the Stock Play of the Day. Thanks for coming.